speaker this morning to start things off is Professor Rick Mendenhall. Professor Mendenhall is the chair of the finance department. He has been the chair of the finance department since sometime last summer. July 1. And he's still alive and breathing, and very excited to come in and tell all of you what goes on in finance and what the opportunities are. So, Rick.
Thanks, sir. My understanding is this on? This stuff right?
Should be on now.
Testing. My understanding is that I'm wearing this just because we're being recorded today. I certainly don't need it to speak to this group right here. Let me apologize in advance. I've been teaching all morning. I've taught a couple of MBA classes this morning from 8 till almost noon, and if my voice goes, it was actually going about 8:15 this morning, so I'm fighting something like a lot of you probably are. Are we still okay? Okay. Okay. I've been at Notre Dame for a long time. I did just become the department chair last summer. I've been in the finance department long before it was the Mendoza College of Business. Before this building was built, I came here in 1985, and so I've been a part of the finance department for a long time, and I have found it very satisfying to be here. I have some slides today, and I'm going to talk about, well, something like what is finance. And let me tell you some of the things that I'm not going to do today. I'm not going to try to sell you on finance. I'm not going to try to discourage you from majoring in finance. But I think that you should figure out who you are to the extent you can at your age. I certainly didn't know who I was when I was your age. But I think you should try to figure out who you are and what lights your fire. You know, what do you find exciting? What do you find interesting? What do you find fun? Because I think that's what you should do. That's what you should major in. And Doug sent me a link to people who have addressed you earlier, and I didn't watch that much of those previous talks because I didn't want to do what they did. If I watched too much, I would say, oh, I have to do this or I have to do that. But I did watch a little bit of Mike Krant, and I don't know if you remember who Mike is, the soon-to-be chair of the management department. And I know Mike very well. Mike hasn't been here as long as I have, but he's been here quite a while, and I've served on committees with Mike, and I have a lot of respect for him. And he said some things that I really agree with. And one of the things he said is, you know, you've got to listen to your gut, and you have to find out what you enjoy. And I can't, you know, I don't give much advice to people, mainly because I think they probably won't take it anyway. But and also because who am I to give advice? But who am I to you? I'm somebody who's been around a lot longer than you have. I'm somebody who's had jobs that he really detested. I'm somebody who's had jobs that he's really loved, like the one I have now. And I can tell you, you can't make enough money to buy a nice enough house, to buy a nice enough car, to buy nice enough vacations to make up for having a job you don't enjoy. So even though you may major in one thing and you may turn around completely and end up doing something else, as you make decisions in your life, I think you have to say, is this a good match for me? And I will come back to that at the very end of my slides today. Do I have an amount of time I'm supposed to talk? When does this class end? When is it? When? 1:45? Yeah, I won't be talking that long, trust me. I only have, like, I don't know, 10 slides or something. So let me just, I'm not going to try to sell you on finance. It will seem like I am, because I like finance. I am a finance person. So it'll seem like it, but I'm not. You know, when we think about finance, I think finance is important, but I also think marketing is important. I also think managing people is important. I think operations, you know, doing things the most efficient way we can is important. There are many areas of business that are very important. Finance is not the only thing. Okay, let me get into these slides so we can get through these, and I will try. I guess I'm supposed to try to answer questions after I do this. I don't have all the answers, but I'll tell you what I know. For convenience, I've broken finance into corporate finance, investments, and financial institutions, banks, commercial banks, investment banks, if there are any investment banks left. By the time you graduate, there will be investment banks, I'm confident. Now, I'm not going to give a lecture on financial statements, but when I think about finance, I do think about the balance sheet. Now, you may be sitting out there, I don't know what you're freshmen, right? You may not know what a balance sheet is. A balance sheet is a financial statement. It provides information to prospective stockholders, to prospective somebody who might supply the company, give them raw materials, etc. Prospective employees. They are balance sheets, income statements are all financial statements. They are to provide information to interested parties. When I think about finance, I think about a balance sheet. On the left side, as we look at it, we have assets. These are the things the firm uses to produce goods and services. Okay, assets are things like land, factories, equipment, machines, also inventory. These are the things that a company has. And our point today is not to understand the balance sheet, but it's to understand finance. Companies make investment decisions. What project should we undertake? And if we undertake this project, then what assets does that imply we have to buy? We have to buy this land, we have to build this plant, etc. Those we call investment decisions. Under the topic of corporate finance, what are we going to invest in? Here are some examples of corporate investment decisions. FedEx and Delta, I had to check. Is it still Delta? I guess it is. Delta and Northwest merged, and I guess they're now Delta. I don't think there's a Northwest Airlines. I served in the Navy, and I have friends who are Navy pilots. I have friends who flew for Delta and friends who flew for Northwest. I guess the Northwest guy is now a Delta guy. But FedEx and Delta have to decide, are we going to buy these planes that cost less, or are we going to buy these comparable planes that cost more but cost less to maintain and operate? A finance person can solve that problem. How do we decide which of these planes best is lowest cost, given that they do the same operationally? Or we might say they might be different operationally, and we would have to find a way of taking that into consideration. Should we introduce this new product? Now, let's say that somebody in your company comes up with a new whatever, a new soap, a new computer chip, a new anything. Does it make economic sense to introduce this product? Does it make is there a chance that we'll increase the value of our firm? If it doesn't make economic sense, let's not do it. Let's not do it. Okay. Should we build this component or buy it? You know, we have to, if it's available for purchase, we know what that price is. We have to figure out how much would it cost to make this component. Finance people are involved in making that kind of decision. Almost every business decision has financial consequences and requires finance people to assess those consequences. So in these decisions, finance people are not working alone. They're working with the accountants who provide information. They're working with the operations management people on saying, how can this part be made? What's the best technology that we can use? They're working with a lot of different people, but they have a specific role. I want to give you another decision that I found very interesting. This was many years ago. And that is, there was a radio station in Chicago. I don't remember how many years ago this was. It was a very long time ago. But there was a radio station in Chicago that said, we're going to go without commercial interruption for 6 weeks. We're going to do nothing but play music. We're going to make some announcements. But we're not going to have any commercials for 6 weeks. And when I listened to that, I thought, wow. I hope there's somebody in the back room who's figured out that this is an investment decision. What are they investing? They're investing all the advertising revenue that they would have gotten for 6 weeks. They're investing that today or over the next 6 weeks in exchange for what? They hope that they get a lot more listeners. Hey, this is a great station. I never have to listen to commercials. And after they introduce commercials, they'll be able to charge a higher rate for them. And sure, some of the people are going to stop listening because, oh, now I have to listen to commercials. But some of their listeners will clearly have developed, they've decided they like that station, they'll continue listening. So I'd like to think there was somebody in the back room saying, okay, this is what we're giving up. This is the value of what we think we're going to get. And doing sensitivity analyses and saying, what if we're wrong? Well, maybe there wasn't somebody in the back room because that station went out of business. But that's an investment decision. We're giving up this set of cash flows in exchange for what we hope will be larger cash flows in the future. Does it make economic sense? That's something a finance person would assess. Now, let's take a look at the other side of the balance sheet. On the left side, it's finance people assist in deciding which investment decision should be made. On the right-hand side of the balance sheet, here we have the liabilities and equities. If a firm has a factory, somebody had to provide the money for that factory. Somebody had to pay for it. Well, that can be stockholders. Stockholders kick in money. Bondholders kick in money. On the right-hand side, we have the way the firm obtains money to pay for the things it uses, to pay for the assets. These are called financing decisions. How do we finance this piece of land? How do we finance this plant? How do we finance all these assets that we're going to use that allow us to take on these projects to make money? There are many decisions to be made on the financing side of the balance sheet. Firms raise money, as I was just saying, to obtain assets by issuing stock and bonds. How much equity should we use? How much should we raise via stock, and how much should we raise via debt, via bonds? So we have to decide. There's a trade-off here. I can't give a long lecture on finance, but the bottom line between stock and bonds is this. Bonds are cheaper to the corporation than equity, than stocks. When you issue stocks, you're issuing ownership. You're diluting the ownership of everybody, every currently existing shareholder of that company. Stock tends to be expensive. That sounds bad. But debt has a downside too. The more debt you have, the riskier the company becomes. The riskier the stock becomes, and the riskier the existing debt becomes. So you have to find a trade-off between various issues regarding this question. How much equity do we use, and how much debt do we use? Finance people help to make that decision. In fact, that's almost purely a finance person decision. Once we've decided that we want to have so much debt, we have to decide what kind of debt. Should it be long-term bonds? One of my friends many years ago owned a 40-year bond. He owned a bond that matured in 40 years, paid off its face or par value 40 years from now. Other ways of borrowing are very short-term. So some are in between. We have to decide what makes the most sense. We have to look at current market conditions. We have to think about what we're currently financing with those bonds. How much does it cost us in annual percent to raise money to use for assets? In my MBA classes this morning, this is what I was talking about. Companies have to know how much it costs them to raise money. What if it costs a company 15% to raise $1? But what if, on average, its projects are earning 10%? That's not good, right? We have to know what's it cost us to raise money so that we can assess projects and make sure that those projects are good economic projects. They're worth more than they cost us. We can't know that unless we know how much it costs us to raise money. What is the cost of raising $1? That's a non-trivial exercise, and most people do it incorrectly. But that's what finance people do. How much do we pay out to our shareholders in dividends? This is also a financing decision. We have to decide, what is our clientele? Do people buy our stock because they need the income from dividends, or are they looking for long-term capital gains? Dividends have a downside. You might say, hey, it's cash. A dividend means the company gives you money, right? That sounds good. But the bad news is, if it's somebody like me, I don't spend what I make. I certainly don't want my investments to kick cash to me every year and make me pay taxes every year on that cash. So the finance people have to decide how much should we pay in dividends, and what if we change our dividend policy? What effect might that have on the share value? Will we scare away shareholders if we don't have a constant dividend policy? These are just a bunch of decisions that finance people either make themselves or they are involved with other people in making. I'm going to spend we're pretty far along. We're on slide 7. I think we're almost done, by the way, so don't worry. Don't think I'm going to be up here for an hour or anything like that. I spent most of the time on corporate finance, but let's talk about investments. I'm actually an investments professor. I like investments a lot. I went into the PhD program at Indiana University because I liked investments so much I wanted to study it further. And here are some questions we address in investments. What methods do investors use to try to pick good investments? We call that active management, trying to beat the market, right? We try to buy stocks that are going to go up a lot, try to avoid stocks that are going to go down. That's called active management. What do investors use? What techniques are available? That's something we talk about in investments. How easy is it to pick good investments? That's called market efficiency. Market efficiency means how smart are prices. When I see a stock price of $18 for a share of Microsoft, to what extent does that reflect the value of a share of Microsoft? And what we find is markets are pretty good at this. Markets are pretty good at assessing the value of a stock. They're not perfect. And if you've watched the financial markets over the last year, I don't think people at the beginning of 2008 thought that the U.S. stock market was going to fall by 37% over the course of 2008. So financial markets are not perfect. But it turns out that it's tough to beat the market. It's difficult for managers to do better than market averages. And we talk about that. Do some historically? Absolutely. And one of the names will come up a little bit later. But we talk about this issue. Why is it hard to beat the market? How hard is it to beat the market? How should investors optimally split their money across investments and asset classes? We call that portfolio theory. Given some assumptions, we can tell people exactly how to invest across different asset classes. What do I mean when I say an asset class? U.S. stocks. We might define our asset class that way. U.S. bonds, non-U.S. stocks, non-U.S. bonds, real estate. I don't have to define my asset classes that way. I might define them in a different way. But we talk about, given some assumptions, how should investors split their money to invest optimally? Now, we back off the theory and we say, okay, most people don't follow the theory perfectly. Why not? What falls short? Okay, what can we take from portfolio theory? What can we take from this for the typical investor, for the average investor? And we talk about that as well. Okay, how can derivatives? What's a derivative? A derivative is a security, like a stock or a bond, but it derives its value from something else. That's why it's called a derivative. Simple derivatives would be futures and options. And so we study derivatives in finance, and we study how they can be used. And by the way, they can be used very effectively. Derivatives can be used to reduce risk. Derivatives can be used to protect investors, to protect corporations. But they can and they have been abused. And a lot of that happened in 2007 and especially 2008. But it happened long before that as well. Okay, let me pause here. Are you still with me? Have I used any terms that you want to ask about? You can ask questions at any time, by the way, if you'd like. Okay, I'll just keep talking then, and we'll be done soon. And then I don't know what's going to happen. Okay, these are a bunch of things that we talk about in investments. We talk about a lot of interesting things. Again, I'm a finance person, so I find them interesting. But here's a picture. This was a hedge fund called, I've got LTCM, Long-Term Capital Management. Anybody hear about long-term capital management? This happened about a decade ago. Let's take a look. Now, finance people find this picture very interesting. Right? Here's a company, a hedge fund. Now, if you don't know what a hedge fund is, it's an investment vehicle. It's mostly for rich people and institutions. You'd probably have to put at least $1 million into one of these to be able to invest in it. Long-term capital management had a couple of Nobel Prize winners working for it, and they got a lot of money. And this shows that they grew $1 to over $4 in a period of 4 years. That's a lot, right? Okay, so that's over 40% a year compounded. So they were doing really well. So finance people find that picture really interesting. But we find the rest of the picture even more interesting. Look at what happened to the value of long-term capital management really quickly. And in fact, that $1 that turned into over $4 turned into less than 50 cents in just a couple of months. Finance people look at how were they able to make this money, and more importantly, how were they able to lose it so quickly? And by the way, this actually would have gone far below zero. They'd have lost more money than they had, except the United States government stepped in. So when people talk about 2008 and people taking risks they shouldn't have taken, this isn't new. This has been going on for a long time. And long-term capital management 10 years earlier should have been a warning for us. They weren't that big. They weren't as big as some of the companies that did this 10 years later. Okay, where does that take us? More issues. This is, you might say, 1998. That's ancient history. In 2008, AIG, or I don't know when, in some recent year, AIG was America's largest insurance company. What was a small AIG office in London doing that destroyed all of AIG's value? Again, you say, AIG's still around. They still have value, only because the United States government stepped in and prevented AIG from going under. But a small office in London were trading derivatives, and they destroyed this huge company's value. Probably 40, I don't know how many employees AIG had, but I would guess tens of thousands. 40 employees in London killed the whole company, or should have, had the United States government not stepped in. That's interesting to us. That's interesting to finance people. We talk about things like, what is the credit crunch? I think we can say is, because I think that we're still in the credit crunch. What caused it, and how did it turn into an economic recession? You know, a lot of people say, wow, with 2008, don't we just throw out everything we thought we knew about finance? Absolutely not. Absolutely not. I'm not that surprised by what happened in 2008. I'm surprised by a few things, a few aspects of what happened in 2008. I'm surprised at how interrelated markets are. How could this problem start in one sector and permeate worldwide financial markets? But most things that happened in 2008 could have been foreseen. You might say, oh, did you foresee them? No, I wasn't in a position to. I didn't know the crazy things that people were doing, like most people I know. Some people were in a position to see things, and they said, wow, I can't believe that companies are doing these things. I can't believe that in many cases, companies were using so much debt. You know, so much debt. We talked about that as capital structure. Some companies were using so much leverage that they were incredibly risky and should have known it. Who is Warren Buffett? This is something we find interesting in finance. Warren Buffett's just one person. Why should we care who he is? Well, as of a year ago, Forbes magazine listed him as the world's wealthiest person. Now, he's lost some wealth. He lost some wealth like a lot of us did over 2008. But I saw some more recent numbers, and he was still worth about $50 billion. So he still might be worth studying. Actually, Warren Buffett is an exception to this idea that it's hard to beat the market. Well, it is hard to beat the market, but it hasn't been that hard for Warren Buffett. He's done it on average over the last 40-plus years. Okay, sure, finance is fun, but can I get a job? I don't know how far I want to push this because, again, I don't know what Doug and Sam have to say to you, but these are numbers that they probably gave me, or somebody, I don't know, somebody in the finance office gave me. I'm just going to go over these. You guys may be able to update these numbers. What happened to last year's 221 finance majors? Is this 2007 or 2008? Do you know? Here are the numbers. 78% employed at graduate. 2007. Okay. 78% were employed at graduation. Half of the ones who weren't employed either went to the military, social service, or graduate school, and 11% were still deciding at graduation. By the way, the 2009 numbers are not going to be this good, is my guess. I don't know if you are keeping track of those numbers, but if I were in your shoes as a freshman, the long-term averages are much more relevant. I think things are going to turn around by the time you graduate. I don't think what's happening right now is all that relevant. But again, that's my opinion. And salaries, I don't know why marketing is so low, but the other starting salaries are real similar. Mike Krant said something when he spoke to you that I agree with completely. He said, don't go into finance just because that's where the money is. I couldn't agree more. I have a niece who saw a list of majors and saw their starting salaries, and she said, oh, I'm going to major in chemical engineering. They had the highest starting salary on the list. So she went to Purdue and she majored in chemical engineering. She hated it. She thought it was the most boring thing possible. So she got out of it, and now she works for Accenture. I don't really know what she does, but she seems a lot happier than when she was majoring in chemical engineering. This would be the fact that we're a couple of $1,000s more at the beginning is to me irrelevant. You might say, why'd you put those numbers up there? I don't know, I just didn't have enough slides or something. Where did people go in 2007? Goldman Sachs, Accenture, JP Morgan, Huron Consulting, and HSBC. Let's see. Here's my bottom line. Finance is a good major for some. It's not for everybody, just like everything's not for everybody, right? There are many good majors. I think you should find something you're going to enjoy. Picking the right major is all about finding a good match for you. Not for your roommate, not for your parents, not for your siblings. I majored in math when I was an undergrad, and for a couple of reasons. I told my brother that I was going to major in something related to business, and he said, that's not hard enough. You should major in something harder. And so when I was an undergraduate, they had tables, and there was nobody waiting at the math table. There was no line. So I thought, I'm kind of busy today. I'll go up to the math table, and I majored in math. That was okay, but I'm much happier doing finance than doing math. Picking the right major is all about finding a good match for you, not for my brother. Enjoy solving, okay, are these characteristics, does this describe you? Do you enjoy solving problems by thinking analytically, analyzing things? Are you somewhat quantitative? And I don't mean you have to be a math geek to be a finance person. Definitely not. You have to be comfortable with numbers. You have to be comfortable, generally comfortable with equations. And here's one I think is important, more important for when you get out of school than when you're in school. Are you able to accept? Are you able to live with uncertainty? Because finance people are always making guesses. We're guessing, what will the sales of this product be? Marketing people work on that as well. What will the costs be? All these types of things. This investment, what will earnings of this company be? We're making guesses about how investments returns will correlate. Yeah, we have help making those guesses. We look to history for guidance. We look to other indicators for guidance. But we're always making guesses, and we're always living with uncertainty. When I've talked to people who were successful investment analysts and people who became portfolio managers, and I said, what do you look for in somebody who wants to be an analyst, to analyze investments? They said, we need somebody with a strong self-image. Somebody who can accept that they made a mistake and not feel bad about themselves because they made a mistake. Because in our business, you make mistakes all the time. And you have to accept the fact that you made a mistake, learn from it, and move on. Okay, I think that's all I have. So if you have, I'm not sure, do we go to Q&A or? Okay. If you have any questions, and let me say in advance, I I will anticipate that you can ask questions that I can't answer, and just, I'll do the best I can. And what I'll probably do is when you ask a question, I'll say, "Can you help me with that question?" Okay, or I might say the name Ray Vanderhayden in some cases. Okay, so anything.
I saw that like 3/4 of the graduates went straight to the workforce. Do any of those go back to graduate school?
I'm sure they do.
Okay.
Yeah, I don't have statistics, but absolutely. In fact, I would say that most of them who go into MBA programs or PhD programs do work. They go and work for a while and then come back. I mean, good MBA programs, for the most part, don't want people until they have some number of years of work experience. Absolutely. It's not like law school. My guess is the vast majority of people in law school come right out of undergrad. It's not like that.
Okay. Now, when they go back, is it full-time education versus part-time work?
Both. Both. Yeah, what can I say about that? I mean, we have in this building, or in this college, we have executive MBA programs and we have full-time MBA programs. They both exist. They serve different purposes. I guess I have taught a lot of MBA classes. I've never taught executive MBA classes. I was a full-time MBA. I never was a part-time MBA. So I am biased towards full-time, going to school full-time, focusing on it, getting it over, and then going back to work. That's my bias. Good questions. Anything else? Yes?
Do you think that the finance department is as personal as some of the other ones because it's so big?
Is this personal?
Yeah, just because it's bigger than a lot of the other business majors.
But what are you looking for? You want?
I mean, just do you think people have as much, are the classes bigger? Do people have as much personal contact with professors and advisors?
I think Sam wants to weigh in on that.
Yeah, I think I'd like to weigh in. The finance department has the largest number of faculty assigned to it. So even though it has a large number of students, the faculty-student ratio is about the same as the other departments. So you have an equal opportunity to have access to professors, get questions answered, find a mentor, all those kind of things.
Yeah, I think we have about twice as many faculty as marketing, probably. Accounting and management are big too, but they also do a lot of service in terms of accounting teaches an extra. I think most people know. How many accounting courses do business students have today?
Six.
Six
In the major.
No, for the whole college. Oh, it's not important.
It's two for everybody in college, and then if you're accounting major, 6 more.
So accountants are teaching more service classes. Management has more service classes, so they have faculties about as large as finance. I think I don't know the exact numbers, but we just have more majors. I don't think we're less personal or personal. My guess. Good question.
What are some examples of classes that finance majors take?
Examples?
Sure, yeah, like what is...
Okay, in the finance major, and actually these guys are better at this than I am because they've been at it longer and they just know requirements. But I can tell you, after you take intro, every finance major has to take a course called Advanced Corporate Finance. So some of the stuff that we've been talking about, it would build on your intro course and talk more about how you make these investment decisions. How do you assess whether this is a good project or a bad project? And also probably things like dividend policy, capital structure. All the things I talked about under corporate finance are probably discussed in advanced corporate finance. You also take a course called investments. And all the topics I talked about under investments are discussed in your investments course. So after you take those 2 classes, then you can specialize. By the way, I've never taught a banking course. I've never taught a course in financial institutions. So I can't talk about those courses very much. But after you take investments, you can take a course on bonds. You can take a course on stocks. You can take a course on valuing a company. So those are the types of courses you would take. We also have AIM, by the way, Applied Investment Management. And they manage a live portfolio. I don't know what the value is. I would guess a couple of $1 million, maybe $5 million. Okay. Well, I've never been involved in AIM, of course, so I guess I can be forgiven for being off a little bit. Is it still $5 million?
Well, it was a year ago.
A year ago. So let's see, maybe down 37% or something. So we have a course called AIM, Applied Investment Management, which is a very interesting course. You have to apply to get in that course. They only take about, I think, 25, 28 people, but they manage a live portfolio. Yeah.
What would be some examples of just like day-to-day work that finance ratios do?
Day-to-day work. The same types of things. I have former students who talk to me about assessing the costs associated with introducing a specific product. So they're working with other people and they're trying to assess these costs. They're working with other people, they're trying to evaluate a particular project to say this is a good project, this is a bad project. You have other finance majors who are working with cash management. That's something I really haven't been involved with. I've never consulted in cash management, but just trying to manage cash as efficiently as possible. Because we want our money to work for us, right? And when we're holding it in cash, it's not working for us. So we have people who work in cash management. In investments, you can imagine, we have people who are everything from brokers, which now we don't like to call them brokers, we call them account executives or something like that. You have people who are analysts who might be analyzing an industry and trying to decide which firms in this industry are going to do well, which are going to do poorly. You have assistant portfolio managers and portfolio managers who are actually making the decisions on portfolios. You have traders. Now this world is people who actually, a company decides, maybe a client decides, hey, I want to buy 1,000 shares of this. Somebody actually has to buy it. And so you have traders who sit at trading desks and they buy and sell securities. Now that area is changing so rapidly. I don't want to talk about it very much because I'm sure I'm way behind in that area. It used to be, for example, that the New York Stock Exchange was a place where lots of trading took place in a very specific way, face-to-face, or at least a human being was actually okaying every trade, and now that's almost completely gone away. So that world changes very quickly. So there's a wide range of things that people do. A lot of finance people work as consultants. And what does consultant mean? Just about everything you can imagine. Who are they consulting with? They're consulting with companies regarding all these types of decisions, regarding whether they should merge, whether they should acquire a company, whether they should undertake this project, how they should structure their financing. There are also consultants that consult with pension funds. How should you invest your money? I have a friend who works with what's called a fund of funds, and he works. On one side, his clients are endowments, probably not the University of Notre Dame, but small college endowments that can't afford a full-time manager. We have a guy named Scott Malpass, and Scott Malpass is responsible for the endowment at the University of Notre Dame. And so he makes decisions about asset allocation, how much do we put in U.S. stocks, etc. But if I'm from a small town in south central Indiana, Franklin, Indiana, and there's a college there, Franklin College. Now they aren't one of my friend's clients, but on the one side they could be, and they probably have $100 million endowment. They might put money with my friend, and he would spread that money across many hedge funds and many investment companies. That's something he does. He was a finance major. So there's just a huge range, and there are things for people who are more reflective. An analyst can take time. When I say analyst, covers a multitude of possibilities as well. But I mean somebody who analyzes, an investment analyst. You can take time, you can be reflective, you can use models. To a trader, somebody who's a trader is trading. They're dealing with a lot of noise, they're dealing with a lot of interruptions, etc. So you can have very different personality types in finance. I don't know if that's been very informative other than to say, huge range of things you can do. Huge range of things you can do. So I hope it helps. Other questions? Anything at all? Yes, I'm sorry.
Is there any possibility with kind of the changing financial market at the moment?
Excuse me.
Is there any possibility with kind of how the financial market is changing at the moment that technically the kind of student would be not outdated but kind of behind kind of the rapid kind of change?
What would be behind?
Like the kind of things that we study in finance could change
Oh.
outdated?
Yes and no. As I understand the question, we've undergone such a momentous period of time, and especially 2007, especially 2008. Is it possible that what you study in your finance classes might be out of date or at least behind? And my answer is yes and no. And let me start with no. We study financial principles. We study economic principles. They don't go out of style. They are going to be true today, tomorrow, and just about forever. Basics of risk and return. Basics of something we call arbitrage. Arbitrage is a powerful force in financial markets. And what I mean by that is whenever you can buy something at one price and essentially sell it for a higher price simultaneously, when markets get a little bit out of whack, then people will do that and it will force markets into alignment. A lot of things just simply aren't going to change because they can't. It's like gravity. If gravity changes, we've got big problems, right? If some of these financial principles change, we've got really big problems. So a lot of things can't get behind. On the other hand, in some of your classes, we certainly talk about things like how securities trade. I think that's the best example. That world was trading. That world was changing rapidly long before 2008. And let me give you an example. There was a man named Tom Coleman, and Tom Coleman was what's called a specialist on the New York Stock Exchange. Tom Coleman made a lot of money being a specialist on the New York Stock Exchange. The specialist, to make somewhat long story short, is the person who coordinated trading for a stock or for a number of stocks. Tom Coleman is the one that gave us the post on the first floor of Mendoza. Tom Coleman is the one who paid for the refurbishment of the Basilica. Now, this was long before you people came here. Do you remember what year that would have been? They completely refurbished the Basilica?
I think they finished it in 90 or 91.
Yeah, certainly I was here, so that sounds right. 90 or 91. I mean, this was a major undertaking. Tom Coleman, who's no longer living, but he was a Notre Dame graduate. He funded the refurbishment of the Basilica. He was a very wealthy guy. Being a specialist, when he was a specialist, you could make a ton of money. Today, in my MBA class this morning, I have a guy who was a New York Stock Exchange specialist. Left the business, came into our MBA program, because you can't make very much money as a specialist today. So that's an area that's been changing rapidly. To the extent that professors don't keep up, yeah, things like that, the world changes. When we talk about how we actually apply these things, it can happen. We hope it doesn't. A lot of things are not going to change. Gravity's still going to be gravity, no matter what happens in 2009.
Okay, we have
Arbitrage is still going to be arbitrage.
one more question.
Yes.
How much does the course load that you take in the finance department affect your job offers? Like if you take a lot of courses in investments and you decide later that instead you want to work for, say, a financial regulator, is that a problem?
I don't think it's a problem.
Okay. Remember, the key thing, you're at a university, and what the employers are looking for is diversity in your education and your ability to think. They're going to train you in the specialty that you're going to go into. But if you walk in with good grades, we have people who are getting jobs with finance firms who are English majors. You don't have to be a finance major. So by choosing to take courses, it will not eliminate it. If you take courses and don't do a good job in them, that reduces your chances of opportunity.
My favorite story, absolutely favorite story. About 4 years ago, Notre Dame established what we call a special relationship, what Goldman Sachs calls a special relationship with Goldman. That means that we're one of the 34 schools that Goldman comes to personally and recruits. And as part of this thing, their vice president of human resources and a couple of their recruiters sat down with about 8 of us over in the Morris Inn over lunch, in arts and letters and in business. And the vice president for human resources said something that I just love to remember. What I'm looking for in somebody that I want to recruit is someone who has demonstrated that he or she knows how to learn. Not looking so much at the courses as I am at the achievement, because I need somebody working for my company who knows how to learn. By the way, he said, my undergraduate major was the classics.
So they might ask, why major in finance?
Well, if you want to be able, you could take it, but if you want to be able to get off to a great start and have a lot of this information already and not have to be learning it as you work, that's the reason to major in finance or accounting or marketing or management. I mean, there is a reason this college exists, but there's also a reason that we require you to take 50% of your courses outside of the College of Business. It does make a difference in the kind of person that you're able to become.
Go back to the first statement from Dr. Mendenhall. Have passion for what you study. If you love what you're doing, you're going to do a good job at it, there's going to be opportunities. That's the key thing. And you might love finance. That's great. But if you love accounting or if you love theology, study what you love, and you're going to have great opportunities.
And I think, just to continue with what Sam was saying, if you study your passion, if you get into a line of work that is your passion, you're going to spend more time on it, and you're going to be better at it, and you're going to be more successful at it. So it's a win-win-win. You're going to enjoy it, and you'll be more successful.
Thank you, Doctor. Appreciate it.
Great class.
Okay, Pat, I want to answer.